the gold price continues high without that open interest. So I think what we're seeing in silver, it's, I believe, jumped sufficiently out of their tentacles, of their control, for the price to be determined in the physical markets where you have to own something before you can even sell it. So now I think the same thing is about to happen in gold. We're seeing that open interest really dwindling.
From the point of view, looking at what's going on in precious metals, gold is just moving sideways. Silver has got a nice bid under it, actually. I mean, it really feels firm. And I look forward to your market analysis on this. But if you look at both those precious metals, they should be coming off in the summer months, basically because the establishment will want some cheap stock or to market on their shorts or whatever it might be.
Veteran analysts Andrew Maguire and Alasdair Macleod are observing significant shifts in the silver market that suggest a departure from traditional trading patterns. Maguire attributes silver's recent strength to a notable change in open interest, with activity moving from paper-based derivatives toward physical markets. He describes this as silver having jumped the ring fence, creating conditions where physical pricing increasingly dominates and actual ownership becomes necessary before selling. This transition occurs as manipulation of silver prices by bullion banks continues to be a concern in 2025. The strategic movement from paper-based exposure to physical ownership appears to be altering established market dynamics. As these trends develop, both investors and regulators are monitoring how the growing divergence between paper and physical silver markets may influence pricing mechanisms. Macleod observes the absence of typical summer weakness in precious metals, noting that selling pressure gets absorbed rather than creating sustained declines. This suggests underlying demand remains consistent and supports silver's relative stability compared to historical seasonal patterns. Silver recently reached resistance near $39 an ounce after touching 14-year highs, though periodic selling pressure has brought spot prices to around $38.27 an ounce. Despite these fluctuations, the metal retains momentum that could test its 2011 peaks. A notable factor in this evolving landscape is China's apparent shift in silver market participation. Macleod points to declining silver exports to financial centers in 2024, suggesting a change in China's approach similar to its strategy with rare earths. The pattern became particularly evident in 2023 when Chinese silver exports aligned closely with global shortfalls reported by the Silver Institute. This correlation suggests coordinated market activity rather than coincidence. Before we begin, make sure to like, share, and subscribe. Tap the subscribe button and turn on the notification bell to stay updated with our latest insights.
And silver provides a window. It's obviously, gold is much more complex to follow. The footprints are much easier to read. But the thing is, I think that, and we were talking about 35 resistance. Now that's become support. And in fact, even 36 looks like support. So why is that? And I think what it is that personally, I believe this, and we track our liquidity providers in Asia, and what it's happened, I think that silver has a sufficient open interest, or let's just say the sufficient COMEX open interest and LBMA open interest that has now escaped into the physical markets. I think it's jumped the ring fence. I think they're having very, very much trouble in keeping silver down. And I think it's almost, and to me now, that kind of raises, you mentioned 2020. If we look at gold in 2020, and yet, as you know, the gold price continues higher without that open interest. So I think what we're seeing in silver, it's, I believe, jumped sufficiently out of their tentacles, of their control, for the price to be determined in the physical markets where you have to own something before you can even sell it. So now I think the same thing is about to happen in gold. We're seeing that open interest really dwindling. We see it evaporating. Where's it going? It's not evaporate. It's a finite equation. Where is it going? It's going into the physical markets. So then you've got the unwind of leverage, hence the price increase. So I think that silver is providing the key to what we're seeing in gold, which is it is going to also exit itself from the controls of the LBMA CME, who have been sitting on that between them for 50 odd years. And I think when the physical markets are being determined somewhere else, and you can try and delay Basel III all you want, in the US. All that's going to happen is you don't adhere to that. You continue to play paper games. Well, when the liquidity has flowed out into the physical markets, and they turn around and just simply say, give it to us then. And then essentially, unless the COMEX ultimately becomes equally Basel III compliant, every ounce is going to vanish.
From the point of view, looking at what's going on in precious metals, gold is just moving sideways. Silver has got a nice bid under it, actually. I mean, it really feels firm. And I look forward to your market analysis on this. But if you look at both those precious metals, they should be coming off in the summer months, basically, because the establishment will want some cheap stock or to market on their shorts or whatever it might be. It could happen yet, but there's no sign of it. It's just remarkably firm. And I just get the feeling that anything coming into the market is just taken. The other thing I did notice is that in 2023, China exported an awful lot of silver, and to my mind, was suppressing the market. The thing that was interesting is that amongst the largest takers of this silver were places like Hong Kong, Singapore, and London, which I would regard as predominantly financial centers rather than photovoltaic manufacturers. Last year, 2024, these financial centers dropped off. There was still a sort of net export from China. I mean, there's no doubt that China, in my view, has accumulated an awful lot of silver. It's been stockpiling it over the years, so it's been controlling the market. But I suspect that's changing. And the thing that's interesting is that perhaps with a very quiet change of policy, I mean, we've seen it with rare earths, very good example. But we're now finding that, silver, platinum, and so on. I mean, suddenly there's a behavior going on there, which we're not all that familiar with.
The gold market is undergoing scrutiny from European regulators amid concerns over unstable derivative positions. Andrew Maguire highlights the ECB's Financial Stability Review, which confirms the presence of billions in unbacked, unallocated paper gold and rising foreign derivative exposure, validating his warning that these positions will need to be settled at higher prices, pushing gold upward. The ECB also warns that excessive derivatives leave the market vulnerable to external shocks, especially as central bank demand for gold rises amid geopolitical and economic uncertainty. This mix of rising institutional demand and leveraged exposure presents a growing risk regulators are now closely watching. Alasdair Macleod notes recent ECB commentary on COMEX premiums, observing the institution's cautious tone while highlighting a significant revelation, a 58% rise in gold derivatives exposure by Eurozone institutions over the prior period. The situation occurs alongside surging physical delivery demands on COMEX, creating notable shifts in market dynamics. The ECB has issued formal warnings about increasing counterparty risk in gold derivatives within the euro area, directly linked to the 58% year-over-year increase in outstanding derivatives. Financial institutions attempting to hedge physical gold price exposure through derivatives may inadvertently contribute to the market instability that regulators seek to prevent. Let's get back to the interview.
When you look at your pound, your dollar, your euro in your wallet, I mean, where's the argument? That is debasing rapidly, and it's not. So if I had any spare dollars or euros or pounds, I would just rather quickly as possible put that into gold and silver, because it's simply going to require more of those silly notes to buy the same bit of gold in a month, 2 months, a year from now.
It goes back to the difference between money and credit. Real money is corporeal. I'm talking about the legal position. In other words, it is physical, it is gold and silver, and to a lesser extent, it was copper, though we forget that. I mean, you and I remember coppers. But and everything else, all the credit, including currencies, is incorporeal. In other words, it's nothing. It doesn't even exist other than an obligation in the future.
You're right. The ECB Financial Stability Review, they put out a link to the report, a full report, a long report. But in summary, what they're saying, they were drawing attention to billions of unbacked, as they put it, unbacked, unallocated paper gold positions. And then they identified these, what you're talking about, foreign counterparty derivative exposure, that they said, well, there clearly has to be bought back into rising prices. So it is exactly what you're saying. So yes, when it comes to the end, That's what you're saying. You're going to have to buy it back at a higher price to repay it.
But it's worse than that. It's worse than that. The liquidity in the paper market is backed up by leasing and a rehypothecation of leases and all the rest of it. I would be very surprised if the central banking community are prepared to extend their leases anymore. I think they're saying, no, we're not doing this anymore. And some of them might indeed be saying, we want to store our own gold. Let's have it back. So this is fatal, really, for the paper market. And I suspect that the second half of this year, we're going to see this. Now, the problem you mentioned sort of wider quadrillions and all the rest of it. The problem, of course, for the derivatives market is that many of the actors in the bullion markets are also acting in other derivative markets. So if you've got counterparty risk escalating in bullion markets, then you've got counterparty risk escalating. Every rise in the gold price means that cash flow pressures on mines are not as great as they were. So, I think that, the Citicorps and the UBSs from manufacturers are being given two fingers, basically. I think what you say is very interesting. There is another aspect to this which I want to explore a little bit with you. We had an announcement, I think it was a sort of, monthly commentary coming out of the ECB about what had happened earlier this year with, the premiums on COMEX and how it sucked in bullion and all the rest of it. And it was quite an interesting article, the way it was written, because it was actually trying not to say too much to upset the markets, if you like. That's the feeling I got. But the one thing they said, the reason that we're worried about this is that Eurozone institutions, their derivatives position in gold have increased 58% compared with the previous quarter, or compared with, previous quarter or the previous year, whatever. Now, this is interesting because tied with this, they mentioned the stands for delivery. Now, I haven't seen anyone else talk about this. I've been talking about it for some time, and we've talked about it together. But I thought I'd run some numbers on this. I mean, the stands for delivery are very important. I mean, basically, my hypothesis is that when it became possible that Trump was going to introduce flat 25% tariffs on all commodities, all imports, the whole lot, the problem for COMEX, operators in COMEX, is that they had stand for delivery obligations. And these stand for delivery obligations were accelerated.
Silver and gold are increasingly shifting away from paper-driven pricing toward physical market dynamics, where real demand and supply play a greater role. With rising global uncertainty, central bank accumulation, and weakening confidence in fiat currencies, both metals are gaining renewed recognition as reliable stores of value. As derivative pressures build and physical delivery becomes more dominant, the stage is set for gold and silver to reprice significantly higher in response to tightening supply and growing investor demand. Is silver signaling a major shift in the precious metals market? Let us know your thoughts in the comments below. If you enjoyed this video, don't forget to like, share, and subscribe. Only 4.5% have subscribed, so hit the bell icon and turn on notifications to stay updated. Your support helps us continue delivering the latest market insights to you and the entire community.